Yeah, I'm losing my edge.
Stock spreads, Pete. That is absolutely what we're talking about
Yeah.
today. It's something that's been I don't know if it's been in the news, but it's been in the active traders collective mind this week and this the last 2 weeks, ever since the election, really, because you see stock trends kind of differing and crossing over each other more harshly than they usually do. When we talk about just today's example is going to be largely just the tech sector and the energy sector. And we're going to look at those, and that's going to be the backdrop to which we teach about trading stock spreads. But just as a little background, Pete, when we're talking about stock spreads, what we're really just talking about is, I mean, the spread that you think of with anything, whether it's gambling or whatever. It's the difference between two things that equates them. And so today's conversation, we're looking at that green line and that blue line there and the difference of those things. And we're going to trade that spread by trading technology against energy and see where it gets us. And to start with a little bit of storytelling, we've talked about this in the past, Pete, but technology is currently on a decade-long run of outperforming the other sectors. And when you look at its 2010 to right now, spread value against energy, Pete, technology is like a plus 450. It's an absurd amount here that it's outperforming energy.
Absolutely. So, you know what, and it's interesting because we looked at some context going back in this. It is, I think, you know, when we look at this, we don't see these kind of divergences that often. And they always, I think the takeaway for me though, too, is I always love this as a gut check because it puts perspective around what's truly rich, what's truly cheap when talking about pairs and divergence and convergence. And I think just like trying to pick a top in an underlying or pick a bottom in an underlying that's falling, very rarely do we throw that dart perfectly. And I think that the extreme continues to be interesting and it will influence strategy. And the context is good because you can look at a day like, boy, pick Monday, Tuesday, or Wednesday. You got very different representations of the stock market, under or overperforming. And you could have read way too much into that. A lot of tradable opportunity in the short term, but in terms of bias, this context is awfully important. And the energy piece is, the other piece is we tend to see back in 2000, 2001, or 1999, 2000, we saw this parabolic move in technology over everything else. But it was interesting that energy was pulling in a very different direction in terms of being close to that technology piece, not the underperformance we're seeing here. For me, that is probably the most unusual thing I have seen in my 40 plus years.
Yeah, it is quite unusual. And I'm glad that you alluded a little bit to how similar this is, stock spread trading is to just trading a single stock or a single market. Like when you go to trade Apple or you go to trade the technology sector or you go to trade, I don't even care, corn, you go to trade it because you say, hey, that looks intriguing. Right. You know, that either looks cheap or that looks expensive. And it's the same with spreads. It's just one added parameter there where it's like, wow, technology, it may look expensive to you or cheap or whatever, but you also can have opinion on, wow, the difference between technology and energy, that's intriguing. And this year alone, Pete, is a huge move here between technology. And these are the main characters in today's stories. Stix is the small technology product. XLE is the Spider's energy ETF that you can trade energy stocks with. And then SM75 is this market that has tech stocks and has energy stocks. That's a little bit of a middle ground here, and you can see that in the trading. And so you develop a spread that you think is intriguing. That's step one. But then you already touched on this, Pete, a little bit. Okay, how can I now tell if this is an extreme, if this is business as usual? And I want to put some numbers against this because you might look at this or you might look at this and just say, especially if you started trading in the last couple of years, oh yeah, technology always beats up energy. Right. That just always happens. And there's nothing extreme about this. So I want to put some numbers against validating potential trade in technology against energy here. And I'm going to start by looking at sticks against SM75, which is, for all intents and purposes of today's discussion, technology versus the market at large. It's almost like technology stocks versus the S&P 500 or Dow Jones, which has technology in it, but also has that energy part of it as well. And right now you're seeing the spread value at plus 34% sticks over SM75 for the last year of trading. And now the backdrop, the context for this is the normal range for an annual move between these two products. The normal range for the spread is plus or minus 11%. Now, the extremes in these spreads on the downside were negative 12%. On the upside was positive 42%. So that's what you can put this plus 34% against here. It's sitting right here in this extreme value. It's outside of the normal range. It's not at the max. And it's a similar case here at the plus 84% spread value in technology or sticks versus XLE that you're seeing, where it's right here. It's not at the max, but it's well outside of the range. It's very similar stories here. So the trades to me are very similar. But I will tell you this, Pete, the maximum of plus 99%, the maximum of plus 42% occurred in the last month. You know, this here, especially the technology versus XLE, I crunched 2 decades worth of energy, or 2 decades worth of energy and technology prices, Pete, to create this whole data set here. And the maximum of plus 99% happened a month ago. And so this is all to say that we are right now at this extreme. You know, 84% isn't 99%, 34% isn't 42%, but we're right there, man. Like we are within a month of a 2-decade-long extreme here. And so that's just to show you, you know, the context. If you think, hey, more power to you. If you think that technology will continue to outpace this, and this is just the start, that it should outperform the next year another 99%, then go for it. But just giving you that context. And then I want to conclude, Pete, with, before getting to how you trade it in terms of contracts and shares, this is something that you can illuminate a little bit. And this was honestly, I had a double take. I had to recrunch the numbers on this one because Stix's correlation to SM75 is plus 0.75 for 2020. That seems normal, reasonable. Technology's correlation to energy, the XLE ETF, negative, Pete. And so what do those correlations, how do those make you, what do those mean? And how do those make you feel as a trader who's going to trade tentatively Stix against SM75 or Stix against XLE?
Well, a couple of takeaways here, Frank. The context here is so important. You've done such, I mean, the number crunching is what really gives us the opportunity to make informed decisions and strategies. Honestly, for 2 equity index pairs at 0.75, we've lived in the world traditionally in the 0.9 and above range, whatever equity index you're picking. So for me, 0.75 is a sweet spot of pairs trading. And this is a different because it means there's a lot of elasticity within these pairs, but there is a strong correlation, which is great. So we're seeing that divergence. But when you look at this and so 2 different flavors of the equity market, equity indexes, Stix and SM75, a solid correlation, but one that's materially less than it traditionally is. But when you look, XLE is, again, it's not like this foreign ship floating out at sea. It's a part of the market, but it's still an aggregation of single name underlyings. And this divergence is so I don't know if we call it unsustainable, because it will sit in a frustrating fashion. It will sit and challenge those extremes usually several times before we start to see some play. But the context around this, and I love the fact, just going back to even in the fall, when we fell so dramatically in March and rallied in April, there was semblance of correlation. The breakdown here is like nothing. When you're and again, we're staying in the equity world here. We're not like pulling corn in or something, something bizarre and trying to make a story about 2 products that are at extremes against each other. This is part of that world, but one that is incredibly, if you're a reversion trader or looking for extremes,
Yeah.
this is, you've been able to single out, and this will be the fun part, is how can we construct the opportunities around this? This is truly an extreme we don't often get to trade. And I think at first blush, you look at it and say, well, it doesn't make any sense, that there's got to be more at play here. I think you have to step back, accept the fact, look at it in a little bit of unbiased way, and not try to build a story why these are here, but let's implement a strategy that lets us take advantage of it.
Well, the correlation of being negative between sticks and XLE is off-putting, because it's hard to depend on that.
Right.
If you're trying to trade this divergence here, this 84% living outside what's normal, or this 34% living outside what's normal, with a correlation of negative 0.15 for this relationship, that makes me feel a lot less confident that this will go from plus 84 back to something that's normal, as opposed to here, plus 34%. That's not even half of the extreme of technology to energy, but high correlation there lets me feel a little bit more comfortable with something that should come back to normal, or at least I can depend on it a little bit more. All of that being said, choice is yours. And the trade, thankfully, in either scenario is pretty simple. One contract of sticks equates to one contract of SM75. Very easy trade. And if you're trading on futures margin, that's going to get you to a pairs trade that's under $1,000, which is hard to come by. And then if you're trading sticks against energy, it's about 150 shares per sticks contract, which you can use in the shares world. That's going to be a little bit more expensive on your buying power. You can also look at deltas if you wanted to look at, I think most people would probably look at 530 delta calls or puts in XLE against what would be a long or short sticks position.
Right.
I think that would be the most common setup if you were using deltas and options in XLE against
It'd be the
sticks.
most cost efficient way to do it. Right.
Absolutely. And so, there's a couple different ways to slice this stock spread example that we've put forth today. But it just goes from finding a spread between two stocks or two stock markets that's intriguing, putting some historical context against it, picking your side of the trade, and then implementing it. And you can see here, pretty easy to implement.